Imagine spending your entire life building security for your family. You pay off the mortgage, you build savings, you keep money inside a pension. And because you do not consider yourself wealthy, you assume inheritance tax will never become your problem. Then, your family values the estate. The house is worth more than expected. Old investments have grown. And from April 2027, most unused pension funds are due to be counted for inheritance tax. Suddenly, an ordinary family estate can face a six-figure bill. The danger is not only the tax rate, it is the assumptions people make before the bill appears. They believe every married couple automatically has a £1 million
allowance. They give away a house, but continue living there rent-free. They make gifts without keeping records. Or they leave their family with tax due before probate releases the estate. So why are more families becoming exposed? And what should you check before the rules catch your beneficiaries? Let's find out. Inheritance tax is normally charged at 40% on the taxable part of an estate, above the available allowances. But the final bill depends on who inherits, which assets are included, what gifts were made, and which reliefs genuinely apply.
Click Confirm. By the end of this video, you will understand why frozen thresholds are widening the risk, how the residence allowance works, what changes for pensions in 2027, and which mistakes can leave families searching for cash at the worst possible moment. If you enjoy practical videos about UK tax, pensions, and protecting family wealth, subscribe because we upload videos like this every week. Transition. To see how quickly the problem can grow, consider a family that never believed it was rich enough to worry. The estate that looked safe. Meet Anne. She owns a home worth around £500,000. She also has savings and investments worth roughly £200,000 and an unused pension of about £250,000. Anne intends to leave everything to her adult daughter. At first glance, the family may think the estate is protected because they have heard that a home can increase the inheritance tax threshold. But Anne is not automatically entitled to a $1 million tax-free estate. For an individual, the standard nil rate band is $325,000. A residence nil rate band of up to $175,000 may also apply when a qualifying home passes to direct descendants.
That could provide allowances of around £500,000, depending on the circumstances. From April 2027, most unused pension funds and pension death benefits are due to enter the estate for inheritance tax purposes. If all three assets were included, Anne's estate could approach £950,000. After allowances of roughly £500,000, around £450,000 could remain exposed to tax. At the normal rate, the potential bill could be close to £180,000. This is only an illustration. Debts, exemptions, transferred allowances, previous gifts, and pension details can change the result. But it shows how property and pensions can transform an apparently ordinary estate. Open loop. Anne's problem begins with the most common misunderstanding of all, the famous $1 million inheritance allowance. Trap 1. Believing every family gets $1 million. A qualifying married couple or civil partners may eventually pass on up to around $1 million without inheritance tax when unused allowances transfer and a qualifying home goes to direct descendants. But that outcome is conditional. The residence allowance generally
requires a qualifying home to pass to children, grandchildren, or other direct descendants. It can also reduce once the estate exceeds £2 million. And unmarried couples do not receive the same spouse or civil partner exemption merely because they have lived together for decades. A headline number is not an estate plan. You need to know which allowances apply to your family structure and beneficiaries. Pattern interrupt. Your home may feel like family security.
HMRC sees part of an estate, and the difference between those two views can be enormous. Trap 2. Frozen thresholds and rising assets. The basic nil rate band has remained at $325,000 since the 2009-10 tax year. The residence allowance remains $175,000. Current policy keeps these levels frozen until April 2031. That means tax rates do not need to rise for more estates to become exposed. If property, pensions, or investments grow while allowances remain fixed, the taxable gap can expand through fiscal drag. Someone who bought a modest home decades ago may now own an asset worth far more than the original price. That paper growth can create a tax problem even when the family has little available cash. Trap 3. Assuming pensions will always stay outside the estate. Pensions have often been used as assets to leave to beneficiaries because many discretionary pension death benefits sat outside the estate for inheritance tax. That strategy is changing. From 6 April 2027, most unused pension funds and pension death benefits will be included in the deceased person's estate. Registered scheme death in service benefits are excluded, but many ordinary unused pension pots will be affected. This means an estate plan created several years ago may no longer produce the expected result. The sensible response is not to empty a pension immediately. Large withdrawals can create income tax, reduce retirement security, and move cash into the estate anyway. The response is to review the entire plan before the change begins. Open loop. Some families try to solve the problem by giving assets away, but gifts create another set of traps. Trap 4. Misunderstanding the 7-year rule.
Most lifetime gifts to individuals can fall outside the estate if the donor survives for 7 years. But there are also exemptions. These include a general annual allowance, small gifts in certain circumstances, wedding gifts, and regular gifts made from genuine surplus income. Records are essential. Executors may need dates, amounts, recipients, bank statements, and evidence showing whether gifts came from income or capital. There is also a major property mistake. Giving your home to your children while continuing to live there rent-free normally does not remove it from the estate. The former owner may need to pay full market rent and their share of bills, or genuinely move out and satisfy the relevant rules. Signing over the title while continuing life exactly as before is not a shortcut. Trap 5. Leaving the family rich but cash poor. Inheritance tax is generally due by the end of the 6th month after death, and interest can apply after the deadline. The family may need to begin paying before probate is granted. But what if most of the estate is a house? The beneficiaries may own valuable assets on paper while having little accessible cash. Some tax linked to property can be paid by installments, and banks may release funds through the direct payment scheme. Even so, delays, interest, valuations, and family disagreements can make administration stressful. An estate plan should consider liquidity, not only the estimated bill. The question is not merely, how much will my family inherit? It is, where will the money come from to pay the tax and administer the estate?
How to reduce the risk. First, calculate your estate as if you died today. Include property, savings, investments, personal possessions, business interests, relevant life policies, and pensions expected to enter the calculation. Deduct genuine debts, then test which allowances apply. Second, review your will and pension nominations together. Marriage, divorce, death, new grandchildren, or property changes can make old instructions unsuitable. Third, create a lifetime gift record. Write down the date, value, recipient, purpose, and exemption you believe applies. Keep supporting statements and income records. Fourth, do not give away assets you may need.
Inheritance planning should not leave you unable to fund housing, care, emergencies, or a long retirement. Fifth, review the 2027 pension change before it arrives. Consider how the pension interacts with the will, estate liquidity, beneficiaries, and your own income needs. Finally, seek regulated financial, tax, or legal advice when the estate includes pensions, trusts, businesses, farms,
Overseas assets, or complicated family arrangements. Let's bring everything together. The inheritance tax trap is expanding because the main thresholds are frozen, while property, pensions, and investments can grow. The $1 million figure is not automatic. The residence allowance has conditions and can taper for larger estates. From April 2027, most unused pensions are due to join the estate for inheritance tax. Gifts may need 7 years, correct records, and no retained benefit. And a valuable estate can still leave executors without enough cash to pay the bill on time. Inheritance tax planning is not only for people who describe themselves as wealthy. It is for anyone whose home, pension, and savings could combine into an estate larger than expected. The biggest danger is waiting until the family has no choices left. So value the estate. Check the will. Record gifts. Review pension nominations. And understand which allowances actually apply. The goal is not to avoid tax through risky shortcuts. It is to prevent confusion, unnecessary bills, and forced decisions during a difficult time. If you found this video useful, like, subscribe, and turn on notifications for more practical videos about UK pensions, tax, inheritance, and long-term financial security. Thanks for watching, and I'll see you in the next video.